This learning objective will discuss the forms of business organization and the uses of accounting information. If you wanted to start your own business, you would need to determine the organizational form of your business. You actually have three choices: a sole proprietorship, a partnership, or a corporation. A business owned by one person is a sole proprietorship. It is simple to set up and gives you control over the business. Examples of companies that would form a sole proprietorship are barber, auto repair shops, farms, and a lot of your small retail stores. Another option is for you to work with other individuals to form a partnership. A business owned by two or more persons is referred to as a partnership. They are often formed because one individual does not have enough resources to initiate or expand the business. Sometimes partners bring unique skills or resources to the partnership. You and your partner should formalize your duties and contributions in a written agreement. Retail and service type businesses, including professional practices such as lawyers, doctors, architects, and CPAs, often organize as a partnership. The last option is you can form a corporation, which is a business organized as a separate legal entity owned by stockholders. Investors in a corporation receive shares of stock to indicate their ownership claim. Buying stock in a corporation is often more attractive than investing in a partnership because the shares of stock are easy to sell. We can easily transfer ownership. Selling a partnership or a proprietorship interest is much more involved. Also, individuals can become stockholders by investing relatively small amounts of money. Therefore, it's easier for corporations to raise funds. Many businesses will start out as a sole proprietorship or a partnership and eventually incorporate. The emphasis in this text is going to be on the corporate form of business. Other factors to consider in deciding which organizational form to choose are taxes and legal liability. If you choose a sole proprietorship or a partnership, you generally receive more favorable tax treatment than a corporation. However, proprietors and partners are personally liable for all debts and legal obligations of the business. Corporate stockholders or shareholders are not. In other words, corporate stockholders generally pay higher taxes but have no personal legal liability. We'll actually discuss these issues in more depth in a later chapter. Sole proprietorships, partnerships, and corporations represent the main types of business organizations. Hybrid forms are allowed in all the states. These hybrid business forms combine the tax advantages of partnerships with the limited liability of corporations. Probably the most common among these hybrid types are limited liability companies, LLCs, and S corporations. These forms are discussed extensively in a business law class. In this exercise, you will match each of the following forms of business organization with its set of characteristics. The solutions to this exercise will be provided in the next video. The previous textbook actually quantified this statement, and it said the combined number of proprietorships and partnerships in the United States is more than 5 times the number of corporations. However, the revenue produced by corporations is 8 times greater. Why do you think there are so many more sole proprietorships and partnerships? Why do you think corporations have so much more revenue? Most of the largest enterprises in the United States, for example, Coca-Cola, ExxonMobil, GM, and Citigroup, as well as Microsoft, are all corporations. Because a majority of U.S. business is done by corporations, that's why we're going to emphasize it in this textbook. The purpose of financial information is to provide useful information for decision making. Users of accounting information can be divided into 2 groups: Internal and external users. Internal users of accounting information are managers who plan, organize, and run a business. These include marketing managers, production supervisors, finance directors, and company officers. In running a business, managers must answer many important questions, of which some are included on this slide. To answer these and other questions, managers need detailed information on a timely basis. Accounting provides internal reports, such as a projection of income from a sales campaign and forecast of cash needs for the next year. Companies also present summarized financial information in the form of financial statements, and we will actually discuss this in Learning Objective 3. There are several types of external users of accounting information. Two common ones are investors and creditors. Investors, and I want you to think of this as the owners, use accounting information to make decisions on whether to buy, hold, or sell stock. Creditors, such as a supplier or a banker, will use accounting information to determine the risk of selling on credit or lending money. Some questions that investors and creditors may ask about a company are shown in this slide. The information needs and questions of other external users varies considerably. Examples of other external users are taxing authorities, such as the IRS, customers, labor unions, as well as regulatory agencies such as the SEC. The solutions to this exercise will be provided in the next video. Approximately 20 years ago, the financial press was full of articles about financial scandals, which resulted in a mistrust of financial reporting. Imagine trying to invest money in a company if you thought the financial statements were misstated or incorrect. There is no doubt that a sound economy depends on accurate and dependable financial reporting. United States regulators and lawmakers were very concerned that the economy would suffer if investors lost confidence in corporate accounting because of unethical financial reporting. As a result, Congress passed Sarbanes-Oxley, or SOX, to reduce unethical corporate behavior and to decrease the likelihood of future corporate scandals.